Welcome back. Here with Money, and this week we are talking about alternate investment funds. My guests on the show are FEROZE AZEEZ of Anand Rathi Private Wealth, as well as VAIBHAV SANGHVI of Ambit. VAIBHAV, let's talk a little more about Category 3 now, because your own fund obviously is part of Category 3. When we're talking about regulation and restriction in terms of what all you can do, the sort of strategies that you can work with, the kind of asset classes that you can dabble with, what does the rule say?
So according to the guidelines, what Category 3 can do is basically they are pretty flexible strategies, and the maneuverability of what the SEBI has given in terms of the permissions is pretty high in terms of the flexibility. Having said that, in terms of the asset class, what we can do is currently we can do equity and debt. Currencies and commodities is something which we will wait for the regulator to give a permission to. And what we estimate is basically after the FMC merger with the SEBI, it's just a matter of time when they come into this category.
But essentially, I mean, you're dealing with asset classes which are part of a very well-regulated market setup, very transparent setup in any case.
Absolutely. So, but in terms of the operative or maneuverability of an of a product in that, what you can basically do in Category 3 is basically you have the capacity to take leverage.
And I don't think there is any cap on the quantum of leverage.
No, there is. So the maximum leverage you can take is basically in the ratio of 1:1. So in case if you have 100 rupees of corpus, you can, the maximum notional gross positioning you can take is about 200 rupees. Now that 200 rupees is also specifically mentioned in terms of the guidelines how you can calculate that 200 rupees, and a daily reporting is done from our end to SEBI as part of the regulation. We think that's a great regulation by the SEBI, and I think it's pretty much a forward-looking regulation. So you can do a lot of stuff and try to be away from the traditional risk-return matrix, and this vehicle gives you a great opportunity to do that.
Okay. So, Feroze, now comes the sort of, the challenge of deciding which category you want to go with. One, as you said, not too many sort of investment options there. There's Category 2, and then, of course, there is Category 3. What is it that has, your verdict, your positive thumbs up?
See, Category 2 is something which I would strongly recommend against.
Oh, okay. Why is that?
Why is that? Because if you measured, any investment has 4-5 characteristics which you need to measure before you take the plunge. The first one, of course, is the return. Okay, what's the return I expect, and what has been the past return? So return, if you split into two, what is that I expect out of this specific instrument? If it is anywhere less than 20% post-tax, post-expense return, then you're better off in a mutual fund. 15, 16, 17% returns if you could manage your discipline. Like I was.
Let me ask the fund manager. Would you agree that that's a tough benchmark that Feroze is putting up? But do you think that makes sense, because you're getting into a structured, slightly more complex product, so therefore you have to match up on the returns?
That's
not necessarily for Category 3. I'm saying generally when you're talking about alternate funds.
What we always believe that return is the second hand of risk you take onto the product. Higher the risk and higher is the return, obviously. Now, if you are being exposed to Category 2, where you have lock-ins, where you have, where you don't have the visibility of returns probably till the fund ends, because there are very few exits which we have seen in terms of the private equity in the last so many years. That's an asset class which is illiquid, which is not shown much, and that is why you will always have a little higher return expectation, as you mentioned. In case of something which is pretty much listed, public equity, which can liquidate, their risk parameters are completely different than what you carry onto the Category 2.
Absolutely.
And that's where, he's right in saying that it's a different asset class, and in that you will obviously have a higher return expectation. I'm not saying that a 20% is the right number. It's just that one has to assess their own framework or own profile before investing those.
So, I mean, 20% expected return. Has Category 2 delivered that at all in the past couple of years?
In fact, we did a survey and a study which was supposed to be taking 16 funds of the Category 2, but the Category 2 has been named as Category 2 recently, but they fall into Category 2 if it was so defined about a few years back, almost a decade. We finished a decade of the first real estate fund in India about a year back. So we analyzed about 16 funds, 8 private equity and 8 real estate funds. The output was really, really surprising, and that really put us in a thinking mode. So the outperformance of mutual funds, even plain vanilla debt and equity mutual funds, for this 11,000 crores, which turned itself into 13 being in these 16 funds, could have actually become 20,000 crores. So these 16 people, if had chosen some other profession, these clients would have been richer by about 7,000 crores. And because of the risk, like I was mentioning, this is a high risk because it's an uncharted territory.
Yeah.
If you would have compared it with equity mutual funds, the investors would have been richer by almost 10,000 crores. So that's a lot of value destroyed. This is one. But if you went back and checked the presentations which were made to market this instrument, they were projecting 22-25%, but the aggregate return has been 6.5% for the private equity category and 5.5% for the real estate category.
How much of that, I'm sure fund managers will have their own justifications for it, but to an extent, you think market conditions can be blamed? Because we went through a lull, real estate market still in the doldrums, and we went through the financial crisis, etc.
So
I'm just trying to play the devil's advocate here.
Absolutely, absolutely. So we need to attribute this underperformance to several aspects, right? That's when you will know whether this underperformance will sustain or it will do better. Then when we actually broke down this, there were different reasons why this kind of underperformance has come. One of them definitely is not the market condition. Why? Because you're speaking about 8-10 year periods, right?
It's a long time.
Long periods.
Yeah.
I'm not speaking about short-term volatilities of a couple of months where a person invests in equity mutual funds and he's expecting some return in 6 months. I think it's very unfair on the manager to deliver in 6 months in adverse situations. But this is long periods. In India, 8-10 years is like the longest it could be from an investor's perspective when we speak to investors. So,
all right. So I mean, on one very important parameter, probably the number one parameter, which is return when you're putting your money in an alternate fund, category 2, as you're saying, is probably not holding up very well as of now. What about category 3? What's the realistic expectation there?
See, like I was mentioning, you can do very different risk-return profiles on category 3. You can create a very risky profile of investment or a very safe one. If you're looking at a safe one, so the return range, it can be very vast.
How vast?
How vast? If you're making a post-tax, post-expense return of even 12-13% on a category 3 on a low-risk strategy, it might substantiate entering one's portfolio. If it's a risky strategy, again using the same nomenclature, which is category 3, it might not quench my thirst of 18-20%, will also not maybe quench my thirst. So to answer your question, 12 to 22, depending on where you place this product on the risk return matrix, is what I think would determine what my expectations would be.
All right, so we'll take a quick break on that note. We've spoken about returns. Another important aspect, liquidity. That's something you need to keep in mind when you are investing in alternate funds. And also, how is regulation evolving? What can we expect? Are more products going to come to the market? All that when we come back from this break.